Imagine waking up tomorrow and discovering that trillions of dollars were created overnight. No heist, no magic, no announcement that really explained it. Just new money. Most people would say, that's the problem. That's why everything is expensive. Too much money printing. It sounds obvious. It feels true. And yet, it's not the real problem. Because here's the uncomfortable truth. We've been printing money for decades, quietly, repeatedly, sometimes desperately, and the economy didn't break the way everyone says it should have. Something else did, and that something else is far harder to see. Right now, people are angry at central banks, at governments, at inflation that makes everyday life feel like a slow leak in a tire you can't fix. Rent keeps rising. Groceries feel lighter for the same price. Savings don't feel safe anymore. So we look for a single villain, and money printing is convenient. Simple, visual, easy to blame. But blaming money printing alone is like blaming the thermometer for a fever. To understand why, we need to talk about what money actually is now, not what we were taught it was, not what it used to be, but what it quietly became. Once upon a time, money was limited by something physical. Gold, silver, something you had to dig out of the ground. That world is gone. Today, money is mostly numbers on screens, created by banks, backed by trust, moved at the speed of software. And here's the first twist most people miss. Governments don't print most of the money. Banks do. Every time a bank issues a loan, new money is created. Not transferred, created. Your mortgage, new money. A business loan, new money. Even your credit card balance, new money. This isn't a conspiracy, it's the plumbing of modern finance. Central banks don't flood the economy directly, they influence conditions. Interest rates, liquidity, confidence. They open the tap. Banks decide how much actually flows. Which brings us to a crucial moment in recent history. The global financial system nearly collapsed. Banks stopped trusting each other. Credit froze. So central banks stepped in. They didn't do it because they wanted to. They did it because the alternative was mass failure. They created money, not to hand it to people, but to stabilize balance sheets. This was called quantitative easing. It sounds technical, boring even, but it changed everything. Trillions of dollars were created and used to buy financial assets, bonds, securities, things owned primarily by institutions and the wealthy. That money didn't rush into wages. It didn't rush into factories. It rushed into assets. Stocks went up. Real estate went up. Everything people with assets already owned went up. And this is where the story turns uncomfortable. Because the problem wasn't how much money was created, it was where it went. For years, inflation stayed low. Economists celebrated. Central banks congratulated themselves. But beneath the surface, something was building. An economy where asset prices soared while productive growth lagged. An economy where money chased returns, not usefulness. Capital became cheap, but opportunity did not. Companies didn't invest in long-term growth. They bought back their own shares. Governments didn't invest in resilience. They leaned on debt. And households? They borrowed to survive. The system became addicted to low rates and easy money, not because of greed alone, but because the structure demanded it. Raise rates too fast, markets panic. Stop liquidity, debt becomes unpayable. So the can kept getting kicked. Until something snapped. The pandemic didn't cause the problem, it exposed it. Suddenly, money creation changed direction. This time, money went directly to people, stimulus checks, emergency spending, supply chains already strained. Now, inflation finally showed up, not because money was created, but because real-world capacity couldn't keep up. Too much demand, too little supply. And here's the irony. The same system that inflated assets quietly for years suddenly made inflation visible and political. Now the public noticed. Prices were rising where people actually feel it. Food, fuel, rent. So the narrative hardened. Money printing caused this. But that skips the deeper mechanism. The real issue is not money creation, it's incentives. Our system rewards leverage over patience, speculation over production, short-term returns over long-term stability. Money doesn't flow to what's useful, it flows to what's already winning. And once that cycle starts, printing less money doesn't fix it. In fact, tightening too aggressively can make it worse. Because debt doesn't disappear when money tightens, it becomes heavier. Higher rates don't punish the system evenly. They hit borrowers first, workers first, smaller players first. The largest institutions? They adapt. They hedge. They survive. So we end up with a paradox. We blame money printing, but removing money without restructuring incentives risks collapse. We demand stability, but the system was built on fragility. And here's the part no one likes to say out loud. Modern economies are not designed to stop growing. They're designed to roll forward. Debt assumes future expansion. Markets assume future returns. Governments assume future taxpayers. If growth slows, the math stops working. So when people say, just stop printing money, what they're really saying is reverse decades of structural dependency. That's not a policy. That's a wish. The real problem isn't that money exists. It's that value creation hasn't kept up with financial expansion. We built an economy optimized for financial efficiency, not resilience. An economy where money moves faster than goods, where expectations outrun reality. And once that gap widens enough, something has to give. Either living standards fall, or debts get restructured, or the system resets in a way no one controls. History suggests it's rarely graceful. So the next time you hear someone say, this is all because they printed too much money, listen carefully. Because what they're really pointing at is a system that confused liquidity with prosperity. And the uncomfortable question isn't whether we printed too much money, it's whether the economy we built can survive without printing more. And if it can't, what does that say about the future we're heading into? That's the part no one has an easy answer for.